When I first start trading, I know that options are very complicated rather than buy or sell a stock. So in this video, you will learn easiest way to how to open a covered call position. And before we start, please hit the subscribe and like button. So let's get started. So what is covered call? Covered call also has another name, which is selling call option. So to do that, to sell a call option, you need to have 100 shares of that stock. So let's say you have a 100 shares of Apple, so you are now can sell a call option. This is very important. So after that, you choose expiration date and strike to sell a call option. After the fourth point is you receive your cash. So when you have done with the choosing expiration and strike, which I will show you soon, and you are okay with that, you can think this as a signing a deal. So when the expiration date has arrived, you are obligated to sell your shares from that price. But if your strike price hasn't reached that point, you keep your shares and you receive your cash. Easy as ABC. So there's a 4 steps to do that. To repeat that, you go and buy 100 shares and you choose your expiration date and strike. When you are comfortable with that, you hit the sell button in the call chain, not buy. So basically you are writing an option. So whether you are selling a call or put, if you are on the sell side, you are writing. So buy with the sell, a quick information, if you are selling an option, you are obligated to do that for yourself. So let's continue. So what are the downsides for selling a call option? First thing is, if stock reaches to the moon, like in the GMA or AMC, let's say you bought it from $100 and you sell a call option at a strike price of a $110. So if stock rises in your expiration date to the $150, because of you sold a call option at $110, you are obligated to sell your shares at that price. So you missed $40 sweet profit. But this is a very rare case. So in a normal scenario, it doesn't happen. So if you would like to grow consistently, this is the method. So the second downside is you need a 100 shares, which is you need a capital, right? So let's say if you would like to buy a 100 shares of Apple, you need at least $15,000. Or you can go for a cheaper stock like Palantir. So the stock is trading now at $20 levels. So you need $2,000 to open a covered call position. So if you ask me that, can I open without 100 shares? In some brokers, yes, you can. But this is a very risky situation, because when the expiration date has arrived, you will see in your balance minus 100, so which means that you have been shorted that stock. So it's a bad thing, I believe. And you have unlimited loss. No, you don't have unlimited loss. Unlimited loss means that because you hold 100 shares of that company, let's say your strike price didn't reach to that level and stock keeps going down, and you have received your premium, that's okay. But in the next coming months, you cannot sell a call option. Why? Because I will show you very soon in the option chain that you will not get enough premium to sell a call option. So there is a little bit unlimited loss, but if you are willing to keep this stock, this shouldn't be a problem for you. So let's talk about some good things. What are the advantages? You have a guaranteed profit. So when you sign a deal or when you sell a call option, you have now guaranteed profit at that date. So let's say you sold a call option for $400, so it's guaranteed that you will receive, and sorry, you will not receive, you have already received your $400. You can see in your account balance when you sold a call option. So the second thing is make money while you're holding. So this is the favorite one. So I have a one portfolio that I keeping my stocks in a long term. So while I keeping my appreciation from the stocks, let's say they are rising every year 20%, for example. But while I keeping my stocks, I would like to receive some extra cash. How can I do that? With the selling a call option. So I am selling my call options further out of the money. Let's say if the stock trading like $100, I am aiming for 30 to 40 days between, and minimum the strike price is above from my entry price like 10%. So I am selling call options for $110. So if the stock skyrocketed, I will sell my stocks, which I can buy it later on, no problem. So this is a very good advantage in my opinion. So the question is how you can sell a call option. Now I will show you how to do that in TD Ameritrade. So let's see in the TD Ameritrade. So now we are in the TD Ameritrade and I will show you how you can sell a call option step by step. So you come to a trade section here, as you can see, and you type your desired ticker. And now I will show an example on Apple so you can understand. Let's say now we will choose a 31-day expiration, and you will look at the call side, not the put side. So because we are selling a call option, we will go for call side in the option chain. So as you can see that these are the strike prices, and the current stock price is $158, and stock has down a little bit. What you can do is, let's say your entry price was $158 and you want to sell call option. How you can do that? So simply you can come here and choose your desired strike. Let's say I am very okay to sell whole 100 shares at $165. So what will I get? The question is very simple, and answer is also. So you come to a bid side and you click the 4.25, which means that you will receive $425. Why? Because to calculate your net profit, you need to multiply by 100 these amounts. So this will be your net profit. Because we are buying 100 shares, all option contracts are equal to 100 shares. Don't forget that. So if you are okay with that, you come and you choose your price. You can change the price as you want, and you hit the confirm and send button, and that's it. You don't need to do anything. So if you have a 100 shares of Apple, now you are good to go. You will wait until the day arrives, which is 25 February. And now we are away from that day 31 days. So if stock didn't reach $165, what happens? So you will keep the $425. It's all yours, and you will also keep your stocks. So which means that if Apple fall down below to the $150 levels, so you will in the net loss of $800, but you have received $425. It's so sweet, right? It seems like easy money. Trust me, it is. What is the worst scenario here? If you do this with the hype stocks like Peloton, AMC, etc., you can not sell a call option if you cannot find a sweet premium. What I mean by that, let's say my entry price in Apple was $130 levels, right? So if I would like to sell a call option, let's say on a $200 level, for $200 level, for my promise and for my signature. So let's talk about the worst scenarios. So because everything can happen in the stock market, and let's say you have bought Apple from $185 and now you are in a huge loss and you are in a stress. What you can do? You cannot sell a call option. Why? Because the premiums are so cheap. Let's say as I said before, if your entry price was $185 and if you are okay to sell it $190, you will get just $33 for your promise. So you better not to do this, right? Because if stock rise, if the stock rise next week to the $170 levels, you can get some better premiums, because when stock prices are rising, this chain also going up one by one, which means that premiums are increasing, and which means that our profits are increasing. So that's all for this video. I hope you like it. So if you have any questions, please feel free to ask me, and don't forget to join in Discord group. I am available for any questions you have. See you soon.